3 to 4 long questions, maybe 4. I'll tell you the topics too. I promise amortization is going to be there. That's one. Stock valuation have not been tested really, so that's going to be there. Capital budgeting, ooh, that's a big one. Definitely going to be there. And the remaining one is going to be either from today's class or the final class, the last class. So that's the 4 long questions that you would expect. The 20 to 25 multiple choice question is going to be all over the place. Expected that it's a cumulative exam, so everything is covered. That's covered in the course. But mostly 60 to 70% will be focused on the later half. All right, about 30 to 40% will be from the first half, and mostly from the multiple choice questions. All right. So very similar to the midterm exam kind of format, and I will try to get the mock exam to you guys before Friday. I'll give you guys some mock questions to work on. Okay. Cheat sheet, 1 sheet of paper, 2 sides, handwritten. Okay? Questions? I think those are the most common questions that I get. Good? All right, let's begin. Okay, today's topic. It's gonna be a little lighter topic, all right, compared to the previous topic here. It's gonna be a change of topic. It's funny, of course, how it is being planned out. So now we're focusing a little bit more on the investment side. So if you're interested in investment, this will be a good introduction to you. Today's topic is risk and return. Risk and return. Those are the 2 things that we always care about when we're talking about investment, right? Looking at historical record, risk, return. Risk, return. Those are 2 things that we care about. So these are the assigned chapters. Assigned chapter 10, 10.1, return, 10.2, holding period return, 10.3, statistics, 10.4, average returns, risk-free returns, and then risk statistics again, and more on average return. So those are the basic introductions on risk and return. I'm going to cover that today. So let's first talk about return. We're always interested to find out if we invested in some kind of securities. We want to know, like, how do we do? How well do we do? How do we calculate that? So let's say an example where you purchased some stock in the beginning of the year. 1 year later, you want to know how well you've done on your investment. So this is the very first concept that I've introduced to you. It's called the dollar return. The dollar return. So if you're investing in stocks, the stock return is usually composed of 2 components. One is the dividend component, the dividend that you may or may not receive depending on the stocks. It may declare dividend. So if you receive the dividend, that's one part. The other part will be the capital gain, or what we call the ending market value, depending on if you're going to sell it or not, and what the stock is going to be valued at the end of the period. So a couple of things. Dollar return here, we're only looking at the dollar, right? Not necessarily in a percentage term. So dividend and the change of market value, that equals the dollar return. Time frame, all right? It depends. Right here, we didn't really specify, but in the example, say we'll hold it for 1 year, so this is a 1 year dollar return. However, that's very important when we talk about the standardization of time, all right? Because rarely we will hold something exactly for 1 year. Imagine if we hold the stock and 9 months in, we decided to sell it, we still want to know what is the return, but that time period, that unit will be 9 months. And I'm going to dive a little bit deeper into how we're going to standardize that so that we can compare investments across different time frames. All right, so a little bit more useful instead of calculating the dollar, we're going to calculate the percentage of the return. So the equation goes like this. The percentage return equals the dollar return divided by the beginning market value. Or on the cheat sheet, I like to write it like this. The percentage return dividend plus the change of market value or the change of price divided by the beginning value of the price or the investment. So that's a general equation, Okay, you can expand that to like P1 minus P0, that's fine, but I usually just put a little change symbol here. Okay, so this, interestingly, you can actually expand this. So you can go like, okay, what do you know this here? If I split this, right? This is called dividend yield. Dividend yield. It's a very interesting metric because dividend is usually known, is either is confirmed by the issuing company, or you can kind of predict from their history, right? There's usually very little surprise on dividend, and you know what the price is now. So given that you know dividend and price, you know what the dividend yield is going to be. So this yield, if annualized, you can expect every year I can receive less income. And it's a very useful metric when you're comparing different dividend paying stocks, right? And it will be even more useful if I have some spare money now, I want to invest in something, and let's say a certain stock, you know what, let's do this. Since I have access, okay. Any dividend paying stock, anyone? Pick one. Yes. Want to say that again? Pepsi. Okay, PEP, PepsiCo. So let's take a look at that. Pepsi. Let's scroll down. Where's my dividend yield? Right there. Is that too small? Can you guys see it? Yeah. Dividend yield 4.21. That's pretty good, right? 4.21, meaning 4.21% based on the dividend that's expected divided by the price now. Well, now you have a decision to make. Would you rather put your money in a bank, or would you rather put your money into Pepsi, which you can collect 4.21% over the year? Do you have a 4.21 return in the bank? Not necessarily, right? But then, of course, there are other concerns, because that's not it, right? There's also changing in value of Pepsi. What if the value of Pepsi goes down, then you lose money? But on the bright side, you're also exposed to capital gain. So this part, right? This is the capital gain yield. So your return percentage, your percentage of return is based on these two parts. Dividend yield. And that is capital gain yield. Okay? So that's the fundamental concept. So let's see, let's compare. Like again, dividend yield will be a good comparison. What's the other one that we usually compare Pepsi with? Coca-Cola, KO. All right, Coca-Cola dividend yield 2.67, much less. Maybe Pepsi is a better investment based on dividend yield, but then of course you got to look at all the other things, right? Okay, but if you are looking for a long, long run, meaning that I actually care about dividend, maybe in what scenario for seniors, for example, they don't make incomes anymore, they retire, they rely on dividends. So then once in a while, they don't have to sell the stock, they can actually collect dividend, use that money to pay for their living expense. In that case, the dividend yield of Pepsi, 4.21, will be a little bit more attractive than Coca-Cola at 2.67, okay? So that's the idea, very simple, but if you have any question, please don't hesitate. Yes?
Should we discount the future value of the investment? So let's say like it's 100 year zero, and then like by the time you actually sell the stock, it's year 2 and it's $200. Can we discount it or no?
No. This is a very simple, just how would I put this? In this case, we just want to find out what is the growth, right? And this is nominal growth as well. We're not talking about like inflation or anything. It's like, $100 in, how much is going to be in the future? That's all. It's a good, fast, quick way to get a sense of how your money been doing in the last little while. So here's an example. Let me show you. Suppose you bought 100 shares of XYZ 1 year ago today at $37. Over the last year, you receive $185 in dividend, which is $1.85 per share because there's 100 shares. At the end of the year, the stock sells for $40.33. How did you do? what is your percentage gain of the year? So you would use this formula, right? Basically, you'll plug everything in. There are two approaches to this. You can use the total amount, or you can use the per share amount. It doesn't matter. Either way, you get the same answer. So we got dividend, right? $1.85. And the initial price, 37. Price change. So $40.33 minus 37 divided by 37. So that's basically substituting the number. Let's put this in our calculator. Okay, 14%. That's it. That is our return percentage. Again, in this case, we assume that it is held for 1 year. So this, remember, this is a 1 year return. However, this is not very useful because we cannot always assume that we hold this for 1 year. What if we hold this for less than a year? What if we hold this for longer than 1 year? Then we need to be able to find a consistent way to compare them. So there's another way to look at this. Let me skip this and go back to the previous slide. Let's call this the holding period return. So this is in the book. Holding period return actually do not define how long you're gonna hold it for. You hold it for 1.5 years, 3 years, 5 years, whatever that may be, but I don't care. Just tell me, for the length that I've held this, what is the return? Okay? So the holding period return is a return that investor would get when holding investment over a period of n years. Again, n, it doesn't have to be an integer, but just n number of years. When the return during the year I is giving us Ri, you basically do a compounding. So if I give you a return for each year, let's say R1 is 3%, R2 is 5%, you would just do a compounding until you find the final value. Okay? And this is the holding period return, although time horizon is specified, still not very useful. Because we want to compare returns with the same unit of time. So again, we like to compare apples to apples. Ideally, annually, or monthly, weekly. But the most common practice will be comparing them annually, okay? Let me show you an example how to calculate the holding period return. Suppose your investment provides the following returns over a 3-year period. In year 1, you have a growth of 11%. Year 2, you have a little bit of setback of -5%. Year 3, you have a growth of 9%. So the question here is, what is the holding period return given this number? Okay, so in this case, holding period return. Oh, sorry, I didn't notice that screen didn't come down. Okay. Holding period return for those, 1 plus 11% times 1 minus 5% times 1 plus 9%, and then minus 1. Sorry if I don't know if these guys can see from the left-hand side. There's a minus 1 here. I'll put it on the next line. So meaning 1.11 times 0.95 times 1.09 minus 1. Okay, let's do the math. Okay, so the return over the 3 years, 14.94%. That's the answer of that. I don't know, maybe I'll mix in a few multiple choice questions, something like that, kind of being the easier part of the test. Make sure you understand this is a holding period, okay? It's a holding period. All right, we good? So far so good, easy stuff, right? Now let's talk a little bit about the fun stuff. Amazon, everybody knows the company Amazon. So this is the price graph of Amazon in the last 10 years. So 10 years ago, March 2016, you guys remember where you are? 2016, 10 years ago. Amazon was only $37.04. So you invested in Amazon 10 years ago today. What's the price now? Well, a couple of days ago, when I updated the slide, it was $253.25. Someone do me a favor, what's Amazon trading at now? I don't know, curious to know. Use your Google. What's that? 243. Oh, dropped another $10, no good. But still, that's pretty good, right? From $37 to $243. So the question is, what is the percentage return over that? All right, assuming that we're holding it from year one, which is 10 years ago, all the way now to now. So you would imagine the future value of the investment starting from March 2016, which is when it was 37.04. It will be 37.04 times the annual return of 2016 times 1 plus annual return of 2017 all the way to 2026. That would equal to a couple days price. So that is the formula to find the holding period return, right? Okay, that's how you would find the annual return for each of these years. So, however, there are a couple ways to find average return. Today's class, we're going to talk about risk and return. We're going to talk about return first. There are a couple ways to find returns. And hang on. Sorry, thought I'm missing one slide. Okay, never mind. There are two ways to find returns. The first one is called the arithmetic average return. This is the easiest one to calculate. It's literally just the average of it. The sum of all the returns divided by the number of observations. All right, let's show you an example. The average return example here is suppose your investment provides the following return over a 4-year period. You have 10%, plus 12%, plus 3%, minus 9%. This is the previous 4 years return. What is the arithmetic average return of this? All right, try this, let's do this. It is very important, the calculation is simple, but then it's more important on the conceptual side of things. There's a difference between arithmetic average and geometric average, but let's talk about the arithmetic average first. Okay, arithmetic average, 10% plus 12% plus 3% minus 9% divided by the number of observations, 4. Okay? That's 4%. Very simple stuff. We all know how to do that. Now, what about the geometric average? Okay, here's the thing. In finance, we always prefer to use geometric average whenever it's possible. Why? Because geometric average also has another name called time-weighted average. Time-weighted average. So each return has an equal weight in the geometric average because these are 4 annual returns, so they each are equally weighted. And the geometric average is preferred because it considers period-to-period compounding. Remember that this is a big thing in finance. We learned from day one is the power of compounding. With geometric average, it also will consider the compounding effect. So in that case, this approach, however, is only suitable for buy and hold and I'll explain why that is the case. But let's go over the equation. So simply, you have 1 plus the year 1 times 1 plus year 2 times 1 plus year 3, etc. And then you're going to be rooting to the power of the number of observations. So for the geometric average, all right? So you have 1.1, because 1 plus 10% times 1.12 times 1.03 times 0.91 average, sorry, will be to the root of the power of 4. You get that? Okay. The problem is, how are you going to put this on the calculator? I'm going to show you guys how to punch this in the calculator. I have my way to do it. You guys probably will figure something different, but there's a more efficient way to do this. So let me show you how we're going to do this in the calculator. Okay, so 1 plus 1 times 1 plus 1, 2 times 1 plus 1.03 times 0.91. We all got that, right? The thing is, how do we have a root to the power of 4? So this essentially is 1.1548 to the power of 1/4. Right? So what we can do is on the calculator, you have this y to the power of x, y to the power of x, 4. But then I want to do 1 over 4, so I'm going to flip it using this 1 over x, equal, and done. So, I forgot about the -1. Okay, so I'll do that again. I'll show you how to do this again on the calculator. Again, it is 1.1 times 1.12 times 1.03 times 0.091. Sorry, okay, 0.91. Okay, there you go. Power 4 1/4, because 1/4 is 0.25, right? Equal. And then don't forget to -1, then you get 3.66%. So now we have calculated both averages. On the top we have the arithmetic average, 4%. The bottom we have the geometric average of 3.66%. You notice that there's a difference. All right? Most of the time, geometric average is going to be a little bit smaller, right? Because it does have this compounding effect, which this do not consider. It's just a strict division, okay? And also, the differences between them is depending on how long are you measuring. If you have something that is 10 years, 20 years, and even 30 years, your geometric average, because of the longer time frame, your compounding is going to be even more, so your geometric average is going to be even smaller compared to the arithmetic average. So that's something that you need to know and understand fundamentally. Okay, so that's the answer of that. I swear to God, if I accidentally deleted this slide, I'll go back and check. I feel like I'm missing this. Think about it. Yeah, definitely. I think I did something silly. Move the slide. Okay, never mind. Okay, here's the difference between the two. And then, sorry, let me try to find that slide. I swear to God, I have this slide somewhere. Somehow. Oh, it is this one. Let's change the look of it. Okay, so let's look at the differences between the two. The arithmetic average returns tell you what you earn in a typical year. So you can use this as a ballpark. The average is fine, you know, but you're not going to use it for any kind of serious calculation. Because, for example, if I ask you, okay, what's the estimate return over the last 10 years for Amazon? And you can just take that number, divide it by 10, you're like, yeah, on average, it's about 20%. That's okay. That's a ballpark. However, the geometric average will be less than the arithmetic average unless all the returns are equal. So, however, which one is better? Which one's better? The arithmetic average is overly optimistic for a long horizon. The geometric average is overly pessimistic for a short-term horizon. So please, I can easily come up with a multiple choice question here and asking you the differences between the two and how you can apply these concepts. So for example, I can say, which of the following describes the geometric average? Make sure you understand the difference. There's no memorization as long as you understand how it's being calculated and why do we use it. Okay, so given this drawback, can we combine these two averages to make something in between? Because one is too optimistic, one is too pessimistic. So this person called Bloom came up with something that's like, you know what, why don't we figure out a way that we can draw a balance between the two? And this is called the Bloom's formula. The Bloom formula goes as such, where you would have T and N. What is T? T is the forecast horizon, so depending how many years you're looking forward. N is how many years you're going to look back. Okay, so I'll give you a realistic question here. On this slide, this is the TSX composite. So let's take a look at the TSX composite. Okay, on FactSet, we can just go search TSX composite. So this is the guy, TSX composite. Look at the last year. Oh, that's beautiful. Last 12 months. TSX composite. And let's go down on prices, history, and let's try to get last 10, let's do last 5-year fiscal year. Okay, this is the last 5 year of TSX composite, and here are the changes. Okay, so here's a question for you. Let me make this a little bigger so everyone can see. Sorry. Okay. So we care about changes. All right. This is the TSX composite. We have the changes for the last 5 years. 2022, 23, 24, 25, 26. So if I ask you to use the Bloom formula, based on the historical return of the last 5 years, what is the expected, so I'm running out of chalk here, so I'm going to be weird. I'll try my best. What is the expected annual return? That's a good exam question. Yeah, you know what? I like it. Lucky you guys are here. Let's do this. Based on the historical return of the last 5 years, what is the expected return of the next 3 years? All right, let's give that a try. I'm gonna take a picture of this so I remember. Okay. I have to go run get a new piece of chalk. Why don't you guys start working on these? I give you the 5 annual changes here. I'm not gonna do it, I'll let you guys do it. 5 annual changes. You have to calculate the arithmetic average. You have to calculate the a geometric average, and then you're gonna apply the Bloom's formula to figure out what is the expected. So again, big picture. What's the big picture here? The big picture is we're trying to form a market expectation. We want to know what to expect. What are we going to earn next year? It's very important because as an investment manager, I need to have a forecast. I need to predict. So I can decide whether I should invest my money in the stock market, or should I invest my money in the bond market, or should I just put my money under the mattress, right? So if I ask you, let's just do this for fun, all right? Just guess, without calculation. This is the return for the last 5 years. All right, what's gonna be the TSX return for 2027? What do you think? Guess, 2027. What's gonna be the annual return for the TSX for 2027? What do you think? Guess. 15? Anyone else? Higher? Lower? Crash? No? You guys have to have
I guess it would be lower.
lower?
Yeah.
Okay, how much?
Probably somewhere, not above 10.
Not above 10. Why?
Well, because I think in the recent years we've seen a rapid growth,
Okay.
specifically 2024, 2025, and we
Uh-huh.
can see that in 2026 things started to slow down. Like this is from June 9, so it's basically from today, right? So it's
Mhm.
8.73. So I expect it to grow, not to decline, but on a smaller pace.
Okay, sure. Well, here's the thing, guys. Everybody should have some form of expectation. And I'll mention this again maybe if I get to see you in your future finance course. Finance is an art. I'm not going to criticize and say, no, 15% is going to be wrong. Less than 10% is going to be wrong. Even someone's going to say, I'm going to predict negative 15. I can't come out and say, okay, I think your guess is wrong. No one can tell what the future is. That's not the point. The point is, as a finance professional, you have to have some sort of, this is what we call capital market expectation. You have to have your expectation of where the market is going to be. And this is something that you guys are going to learn because in an interview, whether it's co-op or not, your boss or your employer wants to know what you think about the market. Your boss is not going to criticize your answer, whether this is a correct answer or incorrect answer. Rather, what they want to ask and what they want to see is, number one, do you have an opinion? If you don't, that's not good, right? You tell me you want to be in finance and or business or even economics or accounting, whatever it may be in whatever management discipline. If you don't have an expectation of the market, if you don't have independent ideas or independent thought, you may not get picked, right? That's one. Two is how you're going to justify that. And that's 90% of the game in finance, is how to justify your answer, all right? It's not about having a correct answer, because even Warren Buffett is not going to come up with a perfect answer, but how you're going to justify that answer. So what we're trying to do here is I'm showing you how to justify the answer, all right? If you have no idea, if you really have no idea, why don't you look at the historical data and project that, right? If the last 10 years was this, and I can just go, all right, based on the last 5 years, I can calculate the average to look forward 3 years to see what that is. And that's the justification. If someone's going to challenge you, why 12.5? Well, because I used the Bloom's formula, we took the average of the last 5, projected 3 years, and that's the average. No one's going to criticize that. And then now you look like a superstar. And that's finance, right? So again, that's the big picture. Again, sorry if I forget to remind you, this is how I always like to teach is why are we doing this? Why, right? Is that we're trying to predict where the market's gonna go. Okay, good? So work on that. I'm gonna come back and ask you guys for the answer. I'm gonna go get a piece of chalk. I'll be right back.
Could you just scroll a little bit so we can see?
Yeah, this?
No, the information.
Oh yes. Let me go back to 5 years ago. Okay, the changes, which is here, okay?
Thank you.
Okay. Do we have the arithmetic average? Do we have the, okay, so we got the two averages. So based on this question here, we're gonna apply the Bloom formula, which is this guy. Okay, so we go, what is T? T is the forecast horizon, right? So T equals 3, the next 3 years, N equals 5. Okay, so let's do this. The return would expect to be T minus 1, so that is 2 divided by N minus 1, 4. That is times the geometric average. Okay, plus N minus T 2 N minus 1, 4 times 14.35. So the average of that is literally 50-50. So what we can expect for the return, the annual return of the TSX composite for next year, 14.22. All right. There you go. So that's the big picture. We asked, what do you expect the TSX is going to have a return next year? Well, based on the historical return for the last 5 years, we want to project for the next 3, the annual return will be around 14.22. Again, there's a lot more to that too. Yes?
Sorry, I don't know if I'm wrong, but if for arithmetic average, I have 10.88.
10?
Yes.
10.88?
And then for geometric, I have 10.39.
Is it 10 or 14? I didn't do the calculation. What do you guys have?
I got 10.88 for the arithmetic one, and then but for the other one, I got 14.08.
All right, well, let's verify. 8.73 plus 28.24 plus 17.99 plus 8.12 minus 8.66. Divided by 5. Yeah, I got 10.88. How do you get 14.35? That's incorrect. Thank you. right? Am I right? 10.88. Geometric, am I correct on that one? Are you guys correct on that one? I didn't do the math, I don't know. Geometric average? What's that? Is that you guys? Me? I don't have my phone. Well, my
No, the
phone.
telephone.
Oh, this one. No, it's not. What the heck? Let's not waste time on this. Let's try to figure this out during the break. How about that? But you guys know how to calculate this. Geometric return, average return, Bloom's formula. I'll definitely consider having this in the final exam. Okay, moving forward. It's annoying as hell. Sorry. You know what? We didn't have anything over that creating that noise, right? Oh, hi. I'm an instructor teaching right now at IC 208. It looks like the PC is just making this noise. That's disrupting our class. Can you hear that? I don't know where that comes from. Our financial calculator is actually quite powerful. All right, you can do simple statistics with this, and I'm going to show you how to do this because if you know how to do this, it's going to save you a lot of time. So let's get started. So sorry about this. You're gonna go figure this out. Okay, I have two stocks, X and Y, 5 years of return of stock X and Y. So again, when it comes to risk and return, we would try to figure out with the two stocks, how do they compare in terms of risk? How do they compare in terms of return? And more importantly, in a portfolio setting, how do they interact with one another? This is called correlation, all right? And now, let's get into here. On the calculator, you see number 7 on top of it, the yellow, that says data. 8, it says statistics. So we're gonna go second data. I have stuff in here already, so I wanna clear it. I go second clear work. Second clear work. So now everything is clear. What you see is X1. So in this calculator, that allows you to enter up to 2 variables, X and Y. That's it, X and Y. So if I have an X, which year 1 is 8%, so I go 0.08, enter. Hit the down button, and then now asking for Y1. Y1 is 0.12, enter. X2. 0.21, enter. Y2, 0.27, and etc. You're going to continue to enter all these numbers and make sure you enter them correctly. Y3 is 4.11. 5 is 0.18, and then Y5 is 0.24. Okay, once you're done, it's always a good habit to hit the down or up button to kind of scroll through all the entries that you have to make sure that everything you entered is correct. Sometimes you have typo. All right, looks good for me. Everything looks good. I have 5 years of X and Y. Now I can hit second stat, statistics. All right, so what you see here now, I'm doing a linear regression. Do you remember statistics? This is a linear regression. Hit down. The first thing I see is the number of observations. There are 5 of them. Down again, that is the average of X. Down, what is that? Sx, what do you think? That's the sample deviation. The sample deviation, the standard deviation of sample of X. Go down again, that's the standard deviation of the population of X. I. Continue down, you have Y bar. This is the average of Y, sample standard deviation of Y. And then now you have the standard deviation of the population of Y. This is super handy because without typing, you can actually have all these statistical calculations done for you. And more importantly, if you recall anything from statistics, what is a linear regression? As a refresher, you have a linear regression. You have Y, you have X, you have all these observations, correct? And then a linear regression will find the best fit line, correct? And then, what do we have? A general equation, y equals a plus bx, correct? What is a? What is a? Ah, very good. A. B, the slope is the B, all right? Well, let's scroll down to the calculator. A, done for you. Another one, down, B, done for you. Is that cool? A little calculator like that. You don't need a graphical calculator because similarly it would be done for you. R, this would be the regression score, R squared. And then you have your other stuff, which you probably don't need for now. All right, sum of X, sum of Y, etc. But anyhow, very powerful stuff. Okay, so that's what it does. Next class, we're gonna be using a little bit more of this statistical stuff. But then let's take a short break. But let's this is done, right?
It is done. I'm just gonna check something.
Did I do something wrong?
No, it wasn't you. It was the recording computer.
Okay.
And I've never like heard this before.
Sure. Okay. All right. So before we go on a break, I do have a favor to ask from the class. All right. I mentioned that this is my second time teaching this class, so I was looped into this last fall to fill in for some other instructor. I find that I kind of like this course, so I don't know. I may decide to continue to teach B10 or I'll be done with it, but I'd like to hear from you, all right? Course evaluation. This is important. Despite all the rumors, trust me, it doesn't matter to my career. It is more important to me to know how I can improve, how I can make this a better learning experience for you guys. So I would sincerely ask you guys to please fill in the evaluation. Tell me what you like or what you don't like and how I can modify this to make this a better experience for the next cohort. This will also impact how if you guys ever take my course in the later years, this will also impact how I approach things. Please do so. It's fair. If you don't like it, tell me why you don't like it. Instead of saying this prof sucks, tell me why it sucks and see if I can do something about it, right? So please do that. I will give you guys extra time. So I did the same thing in the morning. I'll leave the room to give you guys privacy. We'll do a 15-minute break instead of a 10. So I'll come back 20 minutes past the hour. Well, we have someone here fixing this computer. We'll come back to class 20 minutes past the hour, all right? So I would really appreciate it if you guys can help me fill out the course evaluation. All right, we're good? I'm gonna take a break anyway.
It is good right now.
All right.